Konsa. So today we will understand about derivative option trading strategies, wherein we will understand few hacks, few tips and tricks where we can go ahead and trade in equity derivatives with an edge. So first of all, I would like to start this video by saying that predicting the direction, forecasting is not 100% of the game. What I mean by this is that always whenever you want to take a trade in options, it is not essential for you to actually predict the market, and it is not very important for us to spend 100 percentage of time only in forecasting. So what I mean is that forecasting obviously is a crucial aspect when we are trading in options, obviously, but not 100 percentage of time should be invested only in forecasting. We should also invest, you know at least, let's say if I'm spending 100 percentage of time, let's say if 60 percentage of time I'm spending in forecasting, rest 40 percentage I should spend in strategy building and picking up the right strategy for my forecast, which actually would change the game over the long run. The reason I'm saying this is because let's say you anticipated that the market might go from 19,300 to, let's say, 20,000, or let's say 19,500 for that matter, and you are keeping a tight stop loss at 19,100. So 200 point positive is where your target is, 200 point negative is where your stop loss is. Now imagine picking up a strategy which doesn't make you money despite the target is achieved. Despite market going to 19,500, still the option strategy that you have picked up, that didn't yield you enough returns. That might be possible in options because a lot of variables are eventually affecting that. So to avoid that, we need to spend a lot of time even on picking up the right strategy, picking up right strike prices is something what we will focus in today's video. But still, we will try to understand how can we go ahead and forecast. We can use, there would be multiple of ways, right? There would be millions of ways. Each and every trader will have some or the other way to kind of forecast the market's direction. But today I will show you few of simple things that I actually do. So one of the ways that I do is I look at the open interest data. So you can navigate to the link in the description box below. Also, it will be there in iCard, and just search for open interest. Search for your favorite instrument. So I like to trade in Nifty and Bank Nifty a lot because of the liquidity and because of the momentum we get out there, right? Anyways, over here, the green color bar is trying to show us call open interest, and the red color bar is trying to show us the put open interest. Now, if you see, the green bar is also in two colors. One is a bit brighter green, and the other one is much more darker, much more denser green. So this is trying to show us, the filled bar is trying to show us that open interest has added. The empty bar, wherever you see a hollow has been created, the open interest has unwinded. So it is trying to show us that. Now, when we look at open interest data, we look at it from seller's perspective. Why is such that? Because option writers are taking negative reward to risk in the market, and still they are preferring to go ahead and write that option. Okay, fine, understood. Now, how can I digest the data? How can I make sense out of this data? Wherever I see huge puts getting written, wherever I see huge put open interest, that strike price will act like my support. And wherever I see huge call open interest, that strike price will act like my support, my resistance. Okay. Heaviest call open interest, resistance, heaviest put open interest, support. Biggest red, support, biggest green, resistance. So that is one aspect I should keep in mind when I am trading. Second thing is, whenever the underlying approaches, okay, that means the future price approaches the support, I'll see that if it respects the support or not. So what I mean is, so let's say this is where my support is placed. So let's say something like this. And now, one fine day, what happens is the market, it actually respects it. Now you can see, right? It is respecting, it is not falling below that. And the moment I see that is happening, then I could say this support is getting established, and there might be a possibility of an reversal, a possibility of an up move from here, right? So whenever something like this gets replicated, I might get ready for a bullish trade over here. Why? Because the support, the heaviest put strike is respected. It is trying to show us that most of the put writers who betted on that strike and sold that put, their view is going correct. So for a bullish forecast, what I want is the underlying to move positive to move up from the highest put open interest strike price. Similarly, vice versa on the call side, I will look out for a reversal, uh, the price going down from the resistance from the highest call open interest strike price. This is one thing what I can do. So wherever I see the instrument going up from the highest put strike, that is where I will get ready for a bullish trade. And wherever I see the stock going down from the highest call open interest strike price, that is where I will get ready for a negative side trade, for a bearish side trade. So this is one thing can be done, and there would be, as I said, a lot of ways. I just want to show one or two just simple ways of achieving this. Another way of trying to add more confidence to this is you can open charts and just plot a daily chart and remove. I don't want all of this. Okay, so I use rolling futures. Okay, and just go to indicators and just I'll search for Bollinger. Okay, so I assume most of us know Bollinger, okay, but still if someone doesn't know it, so statistics says that 95% of data will fall under second standard deviation. Okay, so it is marking nothing but the second standard deviation. So it's this is the mean, which is a 20 period moving average, and this is where the two standard deviation up is, and this is where the two standard deviation down is. So now if you see in most of the cases, you'll see that whenever it touches this upper standard deviation, the upper Bollinger, it is called the upper band, it kind of retraces from there. And whenever it touches the lower Bollinger, you'll see that in most of the cases, it kind of bounces up from there. Okay, so this strategy may not give you 100% strike rate, but at least if you can amplify it by a better option strategy, then it would make a lot of sense. Apart from that, what I'll use is I'll see that if the underlying is at the lower Bollinger Band, which will tell me that there is a good possibility that there might come a reversal. That is the first thing. Second thing, I will also see where the highest put open interest strike price is placed. So when I see that the highest put open interest strike price and the lower Bollinger Band is placed at the same place, more or less similar place, and the moment I see reversal, I could say that okay, I might expect some positive movements to happen in the market. This is the first thing, and vice versa on the upside. Whenever I see that it is touching the upper Bollinger, and the moment I see that there is some kind of reversal happening, some kind of cool off happening, that is the time I will be ready for a bearish side trade. Now here comes the most crucial part. There would be n number of ways, okay, millions of ways to forecast the market, to predict where the market might go. But if I want to build a strategy, if I want to play a forecast, I want to, let's say, trade a bullish V1 Nifty, then what strategy should I take? Should I go ahead and buy a call option? Should I go ahead and create a bull call spread? Should I go ahead and create a ratio call spread? I would never know, right? What I mean is, so let me just open option chain for all of us. By the way, again, option chain is free to everybody who has signed up with Quantsap, and this data updates in real time. Do check out the link in the description box below and do have your hands on the option chain. Now, anyways, coming back. Now, what I mean is, let's say if I am bullish on Nifty, I want to create a bullish trade. What is my first trade? What will come to my mind is I will go ahead and buy this call option, which is 19,400. But the problem is the theta is decaying, the Vega is affecting it, and a lot of things are affecting this option premium, due to which this becomes very sensitive, and specifically to time. Now to offset the theta decay, which is 7, what I can do is I can go ahead and buy 19,400, and I can go ahead and sell this one 19,600, correct? Wherein I'll still lose theta, which is roughly 2.5 rupees or 3 rupees maximum, but still losing 7 rupees to theta is still better, right? I'm sorry, what I mean is that in fact, instead of losing 7 rupees to theta, I better lose 2.53 rupees to theta. So what I mean is I lose theta, that is for sure. But if I do a bull call spread, I will lose much lesser theta comparatively. Now, another way of approaching it would be, let's say I sold this, I bought this 19400, okay, and I'm going ahead and selling two lots of 19600. So that is again a ratio call spread. So this way we can combine and we can create over millions of combinations and permutations. But which strategy will give me an edge? That I also really don't know, correct? So for that, we have a very simple analytic of very intelligent algorithm, which is named as optimizer. So optimizer, find strategy. So all we need to do is just define direction, which we learned one way of doing it today. What I do, you can do it with different types of indicator, different type of approaches. My forecast is, let's say till 23rd of August, market Nifty might go to 19,700. And I'm setting a stop loss at 18,950. That is what my forecast is. Now the analytic is asking me, the algorithm is asking me, what is the type of capital you have to deploy in one strategy? I'm saying 5 lakhs. Risk, it's trying to ask me that how much loss are you ready to take if your stop loss is triggered on the target date. Everything what we are doing, it is with respect to the target date. Now I'm saying that I am ready to lose 5,000 rupees if my stop loss is triggered. Limited risk only, all strategies. That means if you want a defined risk strategy or a undefined risk strategy. Limited risk only, just hit apply and you will get the best option strategies what can be played around to tackle this view, which is bullish up to 23rd of August. I'm expecting Nifty might go to 19,700 and I'm expecting I'll stop out if market goes to 18,950. So it's trying to show us bull call spread, modified call butterfly, bull put spread. So I'll just try to show one of them. So let's say bull call spread. So it has identified what is how much loss you should take trade in. 19,500 strike price, 24th August expiry. The option is right now at 47.95 rupees. So it's trying to say us buy two lots of 19,500 call option of 24 August expiry at 47.95. At the same time, it's asking us to sell two lots of 19,900 call option, 24 August expiry at 2.6 to get a statistical edge of having a bullish view up to this date, which is 23rd of August. And this will give us a statistical edge in the market. So we don't need to do anything manually. All we need to do is just give inputs, and which will eventually help us in having an edge in derivatives trading over here. Not just that, with optimizer, we can also play around with forecasts such as either ways and oscillate. Non-directional strategies can be also played using optimizer. So do check out optimizer. The link would be there in the description box below, and add an edge to your directional derivatives trading by building yourself a best option trading strategy for your forecast.